China just moved the most important lever in the entire silver market, and almost nobody noticed. Not a price lever, a supply lever. Starting January 1st, 2026, China is tightening control over who can export silver and who gets cut off. Licenses, thresholds, state approval. The tap doesn't slow down. The tap gets a lock on it. And when the biggest flow controller in the system puts a lock on the tap, the market doesn't stay normal, it snaps. You were told the silver rally is just momentum. You were told it's just inflation hype. You were told it's just traders chasing a chart. But this move isn't a chart story, it's a pipeline story, and pipelines don't care about your feelings. I'm your host, and this is the channel where we decode what the mainstream skips, so you can see the pattern before it hits the headlines. Here's what happened in plain English. China is moving toward a system where only large, approved exporters can ship silver out. Smaller exporters get boxed out. That sounds boring until you realize what China actually controls. Refining, processing, manufacturing, and the industrial demand engine that eats silver like oxygen. This is why the date matters. January 1st, 2026 is not just a calendar flip. It's a policy flip, a switch. And policy switches don't create slow changes. They create sudden shortages that only show up after it's too late to prepare. Now look at what was happening right before this. Silver ran hard. Gold ran harder. You saw the numbers. Big annual gains, record headlines. Everyone cheering, everyone arguing about targets. But the real story wasn't the price. The real story was that the world has been running a multi-year deficit and pretending inventories are infinite. They're not. Every year demand has been outpacing supply, and the only thing filling the gap has been stockpiles, vault drawdowns, hidden buffers, emergency metal that was never supposed to be touched. And those buffers are now getting thinner in the exact moment China decides to tighten the export gate. Do you see the timing? This is not random. This is not bad luck. This is strategic. Here's the lie people tell themselves. Silver is everywhere. We'll just buy it from somewhere else. Now, that sentence sounds comforting. It's also how you get blindsided. Because the question isn't, does silver exist? The question is, can you get refined, deliverable silver to the places that need it, at scale, on time? And that's where China sits. China isn't just a producer. China is a choke point. A processing and manufacturing giant that touches the metal before the rest of the world uses it. Even when silver is mined elsewhere, the chain often runs through Chinese capacity in some form, refining, components, industrial fabrication, or the products that contain silver. And here's the part that makes this feel like a historical repeat. This is not the first time a quiet silver decision changed the global financial and industrial landscape. History has a name for one of the biggest silver pivots ever, 1873. Most people remember 1873 as a dusty chapter in a textbook. They don't realize it was a real-world demonstration of what happens when you change silver's role inside a system without warning. Back then it was monetary policy. Today it's industrial policy. Different mechanism, same shock. In 1873, the United States quietly altered how silver functioned in the money structure. The public didn't wake up the next day with a siren. There was no breaking news banner saying silver just got erased. It happened in technical language and legal details, in the boring parts nobody reads, and then reality arrived later, like a delayed explosion. When people finally realized what changed, it was already baked into the system. Miners showed up with metal expecting a certain outcome, and the rules had already shifted. The shock rippled through credit, confidence, and the economy, panic, failures, unemployment, a long contraction that people at the time felt in their bones. Now fast forward. China isn't demonetizing silver. China is effectively saying, this metal is strategic, and we will decide how it flows. That's the inversion. In 1873, silver's monetary role was reduced. In 2026, silver's industrial role is being protected. But either way, the same thing happens to everyone outside the decision room. You wake up, and the rules are different. So why would China do this now? Because China can count. China knows the green transition isn't a slogan. It's hardware, it's factories, it's grids, it's charging networks, it's solar deployments, it's data centers. And silver is not a decorative metal in that world. Silver is a performance metal. Silver is used because it conducts electricity better than anything else. That's not marketing, that's physics. You can substitute in some applications, but you pay a penalty. Lower efficiency, higher heat. Higher failure rates, lower output. That penalty is tolerable in some products and catastrophic in others. Now take the biggest silver-eating machine in modern industry, solar. Solar panels don't just use silver. Solar uses silver as the conductive paste and contacts that make the whole system work at high efficiency. You can thrift it down for a while, and manufacturers did, because they had to. But then the technology evolves. Newer cell architectures can pull more performance, and some of those shifts can increase silver intensity again. That's the hidden kicker people ignore when they say they'll just use less. They can't always use less. Sometimes the next step forward costs more silver, not less. Now stack another demand engine on top: electric vehicles and charging infrastructure. EVs aren't just batteries. EVs are power electronics, inverters, control systems, high current switching, reliable connectors, and charging hardware that has to survive heat, weather, and repeated cycling. Silver shows up everywhere those constraints exist. Then stack the third engine: data centers and AI infrastructure. Every AI boom headline you read is a metal demand headline wearing a hoodie. Data centers are basically industrial electricity machines. They need reliable connectivity and high-performance contacts. The grid upgrades to feed them need components that don't fail under load. Silver quietly rides inside that build-out. So when China looks at the next 5 to 10 years, they don't see a commodity chart. They see a national competitiveness problem. If you manufacture most of the world's solar hardware, you don't want to be the country that exports away the metal your own factories need. If you want to dominate EVs, you don't want to be begging someone else for the conductive materials that keep your systems efficient and reliable. If you want to control the supply chain, you don't let the supply chain leak. This is resource sovereignty. It's not emotional, it's rational. And it's especially rational when the market has been running deficits. Now let's talk about deficits, because this is where people get trapped by headlines. A deficit doesn't mean prices go up tomorrow. A deficit means inventories get eaten quietly, consistently. And then one day you hit a threshold where the market stops behaving politely. For years, the world has been consuming more silver than it produces. That gap doesn't vanish. It gets funded by stockpiles, exchange inventories, ETFs, private hoards, industrial buffers. You can do that for a while. You cannot do that forever. And you can't do it forever while the biggest industrial consumer and processor decides to tighten export permissions. That's the collision. This is why focusing only on spot price is a rookie mistake. Spot is the paper story. Physical tightness shows up somewhere else first. Premiums, delivery delays, lease rates, inventory drawdowns, sudden backwardation, and the weird behavior where the official price says one thing and the real-world availability says another. If you've ever tried to buy physical metal during a true squeeze, you know the feeling. The screen says one price, the product says out of stock, or the premium is absurd, or delivery is pushed out weeks. That's the market telling you the paper price is a headline, not a guarantee. Now imagine that behavior spreads from retail into industry. Industry doesn't panic tweet. Industry signs contracts. Industry locks supply. Industry pays up quietly. And when industry starts locking supply, the available float shrinks even faster because metal stops circulating. It gets pulled into long-term pipelines and stays there. That's the nightmare scenario for anyone assuming there will always be silver for sale. So here's the key question. When the export controls start, does the shortage merely continue or does it accelerate? If China's restrictions meaningfully reduce export flow, the deficit doesn't stay the same. It expands. And because the market is already tight, even a modest reduction can create a disproportionate shock. Think about it like this. If you're already running on a thin margin of inventory, and then a supplier tightens access, you don't adjust. You scramble, you overorder, you front run, you build buffer. That behavior itself creates another layer of demand. This is how shortages feed on themselves. And here's where the 1873 pattern becomes more than a history lesson. In 1873, the change wasn't fully felt the day it happened. The system had inertia. People kept behaving as if the old rules still applied. Then a moment arrived where the old assumptions collided with the new rules and the market snapped. That is exactly what can happen here. Manufacturers and buyers who assume 2025 supply terms still exist in 2026 may discover the gate is narrower than they expected. They will rush to secure supply. That rush compresses availability. That compression spikes premiums. Those premiums force difficult decisions across industries. And now the next cliffhanger. What happens when the West responds? Because the West has already started to quietly reclassify silver in strategic terms. You've seen the language shift: critical, national security, supply chain resilience. If those words matter, they're the early warning system. But here's the brutal reality. You can't declare something critical and magically create refining capacity. You can't pass a policy memo and suddenly build mines. You can't tweet domestic supply chain and have it exist next quarter. Mining timelines are measured in years. Permitting timelines can be years by themselves. Refining infrastructure is capital intensive and slow to build, especially under strict environmental standards. So the West is late. Not emotionally late, structurally late. And when you're structurally late, you have two options: pay higher prices or enforce allocation. That's the fork in the road nobody wants to discuss on mainstream TV. If silver becomes tight enough, you will see pressure for prioritization. Industry first, strategic projects first, public access second. That's not a conspiracy theory. That's how critical materials get treated in tight conditions. Now, does that mean bans? Does that mean restrictions? Nobody can promise specifics, but the direction of travel is obvious. When metal is required for national-scale projects, governments lean towards securing supply for those projects. That's why China's move is so powerful. It forces the rest of the world to confront the truth. Silver is not just another commodity. It is embedded inside the infrastructure plan. So let's talk about the gold-silver relationship, because it's a psychological signal. When gold rips and silver lags, it usually means fear is leading and industry hasn't fully repriced. When silver starts catching up hard, it's often because the market realizes this metal isn't just monetary, it's functional. The gold to silver ratio is one of the oldest signals traders watch. It swings wildly during stress, it compresses during silver outperformance cycles. And if industrial tightness intensifies while gold stays elevated, silver can move fast because the market has to reprice both monetary demand and industrial scarcity at the same time. That dual role is what makes silver volatile, not dangerous, volatile. And volatility is the weapon the system uses to shake people out. Big up days, big down days, whiplash. The goal is simple. Make you emotionally exhausted, so you stop paying attention to the structure. But structure is the only thing that matters here. So what should you watch as 2026 begins? Watch physical premiums. If premiums expand while spot is choppy, that's a tightness signal. Watch delivery times. If delays become common, tightness is spreading. Watch reported inventories at major exchanges because persistent drawdowns tell you the market is funding demand from buffers. Watch industrial behavior. Are manufacturers signing longer-term supply deals? Are they paying up for guaranteed delivery? Are they stockpiling? Watch China's enforcement tone. Restrictions on paper can be soft or hard depending on how they're applied. The market will sense it through flows. And here's the biggest tell of all. Watch how quickly the conversation changes. In 1873, the public conversation lagged the policy change. People argued after the system shifted. By the time the debate went mainstream, the consequences were already unfolding. That's the danger today. The debate will come after the squeeze signs become obvious. The early phase is always quiet. Then it becomes loud, fast. Now let's address the biggest objection you're going to hear. They'll just substitute copper. In some applications, yes. In many, no. Copper is cheaper, but it is less conductive than silver. In high-performance solar contacts, that conductivity difference matters. In high-current switching, reliability matters. In precision electronics, failure rates matter. You can engineer around constraints, but engineering takes time. And time is exactly what the market doesn't have if the flow tightens quickly. Substitution is not a switch. It's a redesign cycle. And redesigned cycles don't save you in the year the gate closes. Here's another objection. Recycling will save us. Recycling helps. It does not magically fill a structural deficit overnight. Silver is dispersed across billions of devices in tiny amounts. Recovering it is expensive. It's not like melting a single concentrated bar. And even in categories where recycling is practical, the timeline is slow. Products have life cycles. Devices aren't recycled the day after they're sold. Vehicles stay on roads for years. Solar panels last decades. Recycling is a long game support, not an immediate shock absorber. So if the deficit is deep and flows tighten in early 2026, recycling doesn't prevent the squeeze. It might soften it years later. Now zoom out. Why does this matter beyond silver holders? Because silver is a plumbing metal for the modern world. If the plumbing tightens, you don't just get a metal rally. You get ripple effects, higher input costs, squeezed margins, delayed projects, and supply chain negotiations that quietly change who wins and who loses in manufacturing. That's why this is a 1873 style pattern. Not because the details are identical, but because the system changes are quiet, technical, and underestimated until they destabilize assumptions. And we are at the moment where assumptions are most dangerous. The world assumes it can electrify everything smoothly. The world assumes it can build unlimited solar fast. The world assumes it can scale EVs without constraint. The world assumes it can expand data centers infinitely. Those plans require materials. Silver is one of the materials that doesn't scale easily. Flat supply meets accelerating demand. That alone is enough to create stress. Add a locked export gate, and you change the tempo of the entire market. Now the cliffhanger you need to sit with. What happens when the first major industrial buyer fails to source metal at any reasonable price? That's the moment the narrative flips. That's when this stops being an investor story and becomes a production story. And when production is threatened, the response is never polite. Companies pay up, governments intervene, allocation begins. And the people who are watching only the spot chart will be the last to understand why the real market is moving. So here's what I want from you, because this isn't a one-way broadcast. Do you think China's move is mainly about domestic industry protection, or is it a geopolitical leverage play that will tighten further if tensions rise? And second question, if silver really is becoming strategic, do you think Western governments will react by building supply chains or by controlling access through policy first? Drop your answer in the comments. I read them, and the best takes shape the next breakdown. And if you want more fast, no-fluff analysis like this, subscribe now. One tap, and you don't miss the next trigger event when it hits. Because this story doesn't end on January 1st. That date is the beginning. The lock goes on the tap, the market tests the gate, and then we find out who prepared and who assumed the old world would last forever. And the next time you see a silver dip on a screen, ask yourself one thing. Did the policy unlock, or did the paper just wobble? Because paper can wobble. Pipelines don't. Now stay with me, because the first quarter of 2026 is where the market reveals the truth. And the people who understand the pattern will see it before the headlines do.